Worrisome times for the auto ancillary space as the auto slowdown intensifies, but Minda Industries seems to have managed to stay steady in the March quarter. The situation may, however, require a change as automakers scramble to get future ready. Maruti plans to phase out diesel cars and everybody has to comply with BS6 emission standards. In addition, Minda has taken on greater debt to fund its acquisitions. So is this performance sustainable even as the industry is set for a shakeout? Let's speak to Executive Director and Group CFO Sunil Bohra, who joins us right now on the phone line. Sunil, good having you. Thanks much for joining in. Just first focus on the numbers in the fourth quarter. International revenues around 16% of sales. Do you see the mix changing with more export focus ahead?
Yes, so we are focusing on increasing our export pie. But immediately, we expect it to be in the range of 15 to 20% for 19 and 20. And we are working on long term to add more products to our export kitty. We are focusing on increasing our export shares of sale in Southeast Asia, where we already have a strong presence for last almost a decade, where we manufacture switches and lights. Now the impetus is how to market more products in that region. So there is a continuous focus on increasing our export sales.
Was the PAT drawdown a bit of a worry for you as well? 46% drop is not a usual thing. And, you know, the borrowings uptick that have gone up to about 606 crores. What's the sense that you can give on the leverage situation within Minda?
Yeah, so first of all, PAT is not comparable. The number which you just said is after adding exceptional profit. So in last Q4, we had an exceptional item of 55 crore. So if we exclude that, actually the PAT is increased from 256 crore to 286 crores year on year, which is an increase of 12%. That is on a comparable basis.
About the debt?
And debt, as you know, that in the current year, we had increased our stake in few of our subsidiaries, like TG Minda. We have invested almost 150 crore to increase our stake from 12% to 50%. We have acquired ESIS in Germany. We have acquired telematics business from KPIT. So there have been a series of acquisitions, and also our capex has been higher last year. So if you see, our net debt to equity is at a comfortable level of 0.5. So there is no cause for concern. And our internal metrics, internal target is that we should be comfortable up to net debt and equity of 1:1. So we are well within our target range. It's actually half of our target range.
Right. So, you know, since you just mentioned all of these acquisitions, Mr. Bohra, have the benefits already started kicking in, or when do the benefits of these start reflecting on the numbers?
Yeah, so they have actually started reflecting into our numbers, not in full way. Like ESIS, we acquired only in second half of the year, so you'll see full impact in this year. Same way TG was acquired in middle of the year. KPIT transaction is expecting to sort of start revenues from end of this quarter, so you will see impact of that acquisition actually in the 1920 part of 1920 and full year of 2021.
All right. So, how much could we expect the impact on the revenue from these acquisitions?
If we see KPIT, the last one which you just spoke, next year we are expecting revenue addition of 70 to 100 crores in next year, and year after almost like 150 to 200 crores. ESIS is expected to add almost in a similar number, around 70-80 crores this year. Then TG Minda is a large company. Their revenue is almost 500 crores, but we can't consolidate because of the Ind AS requirement. But it comes as a share of profit. Additionally, whatever capex we have done last year, we have not seen the full impact of that in the last year. Like we have invested and opened a new plant of four-wheel alloy wheels in Gujarat. We have opened a Minda Rika switch plant in Gujarat. We have opened a blow molding plant in MKL. So there have been series of capex which have happened in Gujarat last year. The impact of that will come in this year and year after. So that is the key reason why debt is going up, and the impact in financials in terms of revenue we will see in 1920 and 2021.
Okay. Are you receiving that kind of an order flow? You're making capex, but is it in hopes of the pickup in demand and therefore pickup in orders, or you've got something solid in the pipeline already?
So, to be honest, I think we are also suffering from the slowdown which major OEMs are suffering from. we are not untouched. But what we have been doing is, in terms of increasing our kit value, we have been constantly working on increasing our newer products. This year we are implementing 3 new projects, which is two-wheel alloy wheel, sensor plant, a controller plant. So we are continuously working on sort of getting insulated from the slowdown, while it is very difficult to sort of wish away the impact of the OE slowdown. But our endeavor has always been that we grow more than 2x, 1.5 to 2x of whatever industry growth. So this year, as we see the numbers which have been coming from the OEMs, has been in almost 5 to 6% growth in 1920, and we are expecting more than 10% growth backed with our capexes which we have done last year, and also the newer product additions in current year.
Sure. But do you think these orders that we're talking about and which come in from the major OEM players, you would probably see a margin suffering a bit on that, or you're comfortable with the margins that you currently get, and what would those margins be?
So there are 2 points you just touched based. One is orders and another is margin. So let me address both in sequence. So in terms of orders, that the last 6 months has been very tough for the market, unexpected. Too many negatives, if you may say so, have all coincided at the same time, be it the higher insurance norms, or be it the ILFS issue, be it the transition to newer regulations, be it airbags, sensors. All of this increase the cost of the vehicle, plus the elections, during which it is, all that nobody actually carries cash. So entire consumption economy is getting impacted, consumption-driven economy, and we are not untouched. So we do expect that post the elections, things do settle down, and we are expecting our H2 to be significantly better than H1, backed with not only the buying which is expected in terms of prior to B6 launch, because the cost of buying a new OE, a new vehicle will definitely go up to BS6 norm. So whosoever has been deferring their purchases, we do expect people to come back to market, and hence the H2 to be better. Secondly, the capex impact of our capex which has been undergoing, we'll see a better uptick in H2 versus H1. So we are quite confident and upbeat about our future in next few quarters.
And what about the margin, sir?
In terms of margin, that in last 3 years, we have moved our range from 8-10% to 12-12.5%. And 18-19, we have given our guidance of 12 to 12.5%. And I'm happy to say that full year we have ended at 12.3%. Having reached here, I think this will be a year of consolidation, and we would like to consolidate our margins. Ideally, we would like to improve, but given the current market circumstances, we are targeting to maintain this margin range for 1920 as well.
Okay. A word on the opportunities or the challenges because of the BS6 and the electric vehicles advent as well?
I would say it's an opportunity for Minda purposes, because we are not directly involved in any engine parts. Only couple of products which gets impacted from our BS6 transition is our air filters, canisters, and from EV perspective, it's only our fuel injection for CNG kit. So these are the products which get impacted, so it is not significant. Plus, in terms of BS6 transition, our filters are already BS6 compliant. We are already got orders for BS6 filters. Some of our sensors, I'm happy to say, that are already BS6 compliant, and we already got orders for our sensor business for BS6 engines. In terms of EV, we always believe it's a great opportunity for us, because till now, even though most of our products are agnostic to the fuel consumption system, as you know, be it lights, switches, horns, irrespective of the fuel system, they are required in EV or non-EV. But EV definitely provides an opportunity, and we have our team who is constantly working on identifying new products where we can add and increase our kit value in terms of whenever EV matures.
Okay. Can you leave us with a guidance of what Minda as a company can do in FY20 over what it has done in FY19? Yeah.
So in terms of FY20, as I said, based on the OE guidance of 5-6%, we are expecting a growth north of 10% in revenues, and this is excluding any inorganic acquisition like Harita Seating Systems, which you announced in February. This is excluding the impact of Harita Seating Systems. That company itself is a revenue of 1,000 crores. If we are able to add that acquisition in last quarter, it will add another 250 crores to our top line. So the numbers which you are speaking of 10% and north is not considering that revenue. In terms of margins, as we said, we will target the same margin range for this year, 12 to 12.5%. And in terms of capex, we do expect this year capex to be a little lower than last year, maybe in the range of around 400 crores, because of the 3 new plants which are under construction is 2-wheel alloy wheel, the controller plant, and the sensor plant.